channel. The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are now open on 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And joining me tonight on the panel, we have David Buckland from the Montgomery Fund and also Richard Hemming from Under the Radar. I guess a lot of people would be asking themselves, is this the end of the pullback? We've seen the market dipping sort of below 5,600 points and then bouncing really strongly. So, David, how are you positioning the portfolio at the moment? Is there a lot of money in cash waiting on the sidelines, or are you jumping in?
Yeah, we've still got a lot of money in cash on the sidelines, Julia. We spent a little bit of money during the pullback, but not much. And it'd be fair to say, we'd still say in general terms, we think the market's about 10% overvalued. We're having trouble finding compelling opportunities, and we're also very mindful of the sell-off in the long bond market globally. So if you look at, say, for example, North America, Italy, France, Germany, UK, Australia and Japan, long bonds have sold off on average by about 60 basis points, from about 1% to 1.6%. And I think that's something that most Australians haven't got their mind around.
So you think the volatility in the bond market is going to continue?
I do, yeah. So what has happened is that, obviously, for those that don't know, bonds were up around 12, 14 or 16%, depending on which country you're looking at, in about 1981. They rallied all the way down to roughly 1% across that average. Obviously, in Germany, they got down to next to nothing. And they've all backed up now from an average of 1% to an average of 1.6%. So I think it's the first time for quite a while, from such a low level, we've seen a decent backup. And I think the backup is because, there are some, great green shoot stories. But I think with a bit of green shoots, there is, potential for a little bit of inflation down the track.
Okay. And Richard, when you're looking at your stocks, what does your stock universe look like at the moment? Are there lots of opportunities? What's catching your eye?
Oh, well, I think there's a massive dichotomy in the market between, like, the stocks that capture the market's imagination and can show growth, and and a lot of the market which just hasn't. And in the small caps realm, which I guess are trading on very low PEs, high dividend yields, and I think that they're doing it tough. I think that dichotomy is not going to go away, and I think, even though, like what David's saying is true, stocks at the bigger end are trading along the lines of bonds, and there is a lot of risk there, but I just can't see anything changing anytime soon.
Okay, so it's an interesting world that we're investing in at the moment. We do have our first caller on the line, so let's go straight to Clive from Brisbane. Clive, welcome to the program. What's your question for our panel tonight?
Hi, Julia. I had my eye on a couple of stocks. They're both software stocks. One's Altium, and the other one's GBSC Holdings. I've had my eye on those two for a while. GBSC's pulled back a little bit, but I just want to know if it's good value at this level.
Sure. So we have seen a little bit of a pullback in some of those platform type stocks like GBST and Praemium. Richard, we might start off with you. What's your view on some of these? Well,
I think there's more value in GBST than in Altium from our perspective, but I think GBST is certainly cottoning on to this fintech revolution. Like, they really do have a good business model of let's make it clear, both are software companies. GBST has established a great track record in Australia and has taken that track record of certainly being the choice of back office software in the same way that Bravura did for funds and for brokers, and they're going through FOFA reforms similar to us in the UK, so they're gaining traction in that market. But I think from our perspective, GBT just looks a little bit too expensive, and Altium even more so. Like, it just goes to what I was saying before about the haves and the have-nots in the market. These are companies that have captured the market's imagination, but for them to keep outperforming as they have, we think it's going to be very hard, and you're really sort of playing a momentum game. We're sort of more along the we don't sort of like to play the value game as much. The momentum game as much as we like to look for things that have been sort of left by the market and for various reasons, and we like to pick off value there.
Okay, so a little bit too expensive for you.
They're just a bit too. We feel that we've missed the boat, and that any kind of hiccups are going to be further punished by the market. We are in a bull market after all.
It is a similar feeling that I think a lot of investors have out there. Have we missed the boat? And looking at GBST and Altium, what are your thoughts, David?
So GBST, I like the business model very much, Julia, but it's for us it's just too expensive. With Altium, we got onto that quite early, fortunately, and bought quite a lot of it. Even in fact as early as January this year, or I should say as late as January this year. I think the stock was trading at about $2.80, and in no time at all it rushed up through $5. And when a stock performs like that, when its business model doesn't change immensely, it's a very easy call to say the easy fruit gets picked. And be fair to say that above $5 we certainly took a fair bit of money off the table.
So when you see price momentum like that, you want to see something changing, like a new strategy, a new product? Or...
Well, I think it was interesting as well, Dave, that the stock got sold off on a profit downgrade, and then they upgraded their dividend and the market went for it. Like, I mean, it really went, it goes to show just how in love the market is with dividends. I think
yes.
Price action in that stock, is that what you saw?
Yes, that's right, Richard, but I think our viewers need to get context, and the context is that over 110 years the Australian market has delivered a 10% return a year. Okay, so that's context. So unless you're absolutely on something that's transforming over many, many, many years and just growing and growing and growing and growing, when it gives you a 50 or 60 or 70% return in a matter of a few months, you've got to stand back and say, is this business going to keep growing at such an enormous pace so that share price appreciation is justified, or has it just got too hot? And that's what we need to do, is we need to understand the business model and ask ourselves those pertinent questions.
Okay, so it looks like both our panellists thinking that these stocks are looking a little bit too hot at the moment. That was GBST as well as Altium ALU, the stock code there. Let's go straight to our next caller. We've got Eddie on the line from Adelaide. Eddie, welcome to the show. What's your question tonight?
Yeah, g'day guys. Thanks a lot for taking my call. My question is in regards to Hansen Technologies, HSN. I currently hold a small amount of shares in the company, and they've done quite well. I bought them at about $2. They're at $2.50 now. They've recently made quite a large acquisition of a European company that's cost them, I think, $15 million. And so what they're doing to fund that is they've got a share purchase plan.
Sure.
So they're offering current shareholders up to a maximum of $5,000 worth of their shares for $2.17, which was the price they were at when they had the SPP. They're now up to about $2.50. Can I get your advice? Would I be wise, or is it a good idea to go for their share purchase plan? Obviously already the shares are worth more than they're offering them for the price they're at. So can I get your advice on that, and would that be a good thing to go in on?
Sure. I mean, Eddie's got a good question there. Hansen Technologies, share purchase plan, stock's already higher than what he'll get the shares for. I'd say go for it. You might want to offload some stock, so, you know, it's if you don't want more stock in Hansen. But in terms of the actual underlying company and keeping it, what are your thoughts on this one, David?
Well, Andrew Hansen, the CEO and the founder's son, has done a superb job in this company. I remember, I think it was about 10 years ago, they had a rights issue at 13 cents. Wow. So there you go, you got 20 times your money in a decade. And in fact, I think the finance director is wrapping up on June 30, and I think he might have even picked up a bit of stock at 13 cents. So there you go. That's 10 years of growth for you, and you can do particularly well because it had the living daylights beaten out of it during that period. And what happened was it had contracts with groups like WorldCom who went broke, and that was one of their major customers, and suddenly they had a big hole in their earnings. And Andrew's done a great job finding a lot of new customers. He's diversified the business model into the UK and Europe and even Japan very, very, very successfully. But at the end of the day, the business is now worth well over $400 million. So a $15 million acquisition is not significant for a business of this size today. The question is $2.50 or $2.40 or $2.60, is it cheap or expensive? For us, it's a great business. It's just a bit too expensive.
Okay, so looking too expensive. How about you, Richard? What do you think?
I tend to agree. I think with the sort of quantum of the company's profits compared to what the market capitalisation is, I think you're really paying up for a lot of future growth, and we take the view that we've missed the boat on this one, and there's other stocks where we think we can get better value and easier gains. I mean, it just comes down to, making money off of, even with these sort of companies, are really 20, 30 PE stocks. They really do need to appreciate their earnings for you to impress the market. Whereas if you're looking at a PE of 6 to 10 times, there's not as much that they need to do to impress the market. And stocks like that are more vulnerable if there is a correction.
Okay, so both think it's too expensive. I mean, the last result, we saw EBITDA growing about 24%. They are growing organically as well as making acquisitions. There's so many companies like this. So, I mean, in terms of having a look at the investment universe here in Australia, is it very small, or do you get on some of these momentum plays?
Look, I think, at the end of the day, Australia's a very thin market, and the problem we've got is if you look at, say, for example, the major banks, our 4 major banks, they account for well over 30% of the market. And if you go to any other first world country, the banks might be 10%, 15%, 18%, but they're not 30 or 35 or 40%. So it just tells you, firstly, the banks 40 years ago were 8% of the market. Now they've quadrupled in terms of their importance over 4 decades, but it tells you the rest of the market is thin, particularly if you exclude the material sector.
But I would say there is a big difference between a lot of the people sitting out there and David, who's an institutional manager. I mean, you don't quite need the same fills that David needs, and there isn't quite the liquidity constraints that an individual investor has, and there is a lot of, there is a big, Australian market has a big tail. I mean, it's almost like the Wild West out there sometimes.
Which is where you come in, right, Richard? So looking at Hansen, I mean, the stock's pushing all-time record highs. $2.57 is a record high. Last trade at $2.47. We've got that weaker Australian dollar kicking in. You don't think that's enough?
No, we just look at these stocks and think that we've missed the boat, as I said, and we look at there are other companies that we feel where we can add more value in terms of our time and our research than trying to surf this sort of momentum.
And if you were in it like our caller was?
Well, I wouldn't. I don't think I would be buying, because if they want more money, increasing my exposure, I would certainly be. What we often do when stocks go well is tell people to take your costs out and let your profits run, which is because in this sort of market, these stocks can really fall quite quickly when there is the kind of macro uncertainty that David was talking about.
But one thing I will say is I really do like their annuity income stream. And you can't say that for a lot of stocks. A lot of stocks are much more, I'll call them transactional driven. They're much more annuity income stream driven business model.
Okay, so a little bit more stability in terms of the revenue that they do bring in. That's Hansen Technologies. They have had a fantastic run, up 94% over the past year, but just looking a little bit expensive for our panellists tonight. On that note, we do need to take a break. We'll be back with more after this short break. Welcome back to the shares edition of Your Money, Your Call. We are still taking your calls on 1300 30 34 35, and you can email in yourmoney@skynews.com.au. But let's go straight to our next call. We've got Russ from the Gold Coast on the line. Russ, welcome to the show. What's your question tonight?
Yeah, thank you, Julia. Love the show. Watch it every night.
Thanks, Russ.
2 stocks I've got. One is Monadelphous and the other one is Woodside. Now, I know that Monadelphous is in that services area. Mm-hmm. However, I picked it up at $8.50. And I've just seen it going north ever since. And of course, Woodside, I picked it up at $34, and that's not going too bad either. I really did buy these stocks for the dividend. But I'm very happy with how they've been progressing, even though I don't think David is in that area himself. But yeah, I just want to know whether I should add to my portfolio.
Sure. And I guess, David, the reason why a lot of people aren't in these stocks is because of the volatility, not because there aren't opportunities to make money here. Because as we've seen with Monadelphous, I mean, Ross picked it up at $8.50. It's at $11.43 at the moment, so doing really well. And Woodside Petroleum not only picking them up at $34, but that very attractive dividend yield at the moment as well. Well, what are your thoughts on?
Well, I think Russ has done a great job. You know, he didn't own it at sort of $28 or $29, but he bought it at $8.50. So it's been a great little trade from $8.50 to $11 odd. I mean, at the end of the day, Monadelphous is the bellwether stock in servicing the resource sector, and you know, it's had a very, very harsh time share price wise, and I don't know if from a profit point of view or an activity point of view, much is going to change over the next 2 or 3 years. I think a lot of the resource sector is going to do it pretty tough, particularly now some of these enormous Meccano sets in the coal seam gas and oil industry get developed, and obviously those businesses need far less labour once they're up and running, and that's taking place over the next sort of months or couple of years. So you know, a great trade, but I think it's going to be a pretty tough position to be in the foreseeable future.
Okay, so pretty tough over a 3-year period. I mean, looking at Monadelphous, and you know, we've been talking about a lack of value options on the market. It does have a very low PE ratio. I mean, Richard, would you be getting in on
Well,
something
it's
like
certainly
this?
the sector that we've been looking at recently, because I guess the expectations are so low, and I don't know, like, whether they're institutional grade such stocks, because there is a lack of, I guess, earning certainty, and but there is also like a lot of upside if they win contracts, and we've certainly experienced that. Some of the stocks we're looking at, like UGL, they've been punished, you know, ever since they sold their property group, and you know, they've had a lot of trouble getting their act together. But we look at the underlying business, and often with some of these companies, we think they're actually big caps, you know, trading as a small cap. So like that's where we see some opportunities to make money. That's where we've made money in the past.
Dabbling in the mining services area. What about Woodside?
Well, Woodside is way out of our remit, but I would say that oil and gas is certainly an area, if you're a long-term holder, to look. I mean, Don Volti, you know, who works for Kerry Stokes, is trawling around assets in that sector. And I think that in terms of the oil price, from what I know of it, it has it can rebound a lot quicker than the or companies can act on the supply side to shut down their operations a lot quicker than they can on the iron ore side of things. So there is a lot more potential to make money in that sector. And we look at the smaller end of the sector, like Sundance Energy, which is a fracking operation in America, and we see more leverage on that side of things. But I think on the oil and gas front, we're certainly, that's another area where we see great value and more potential than, say, iron ore.
Okay, so that's Sundance Energy. SEA is the stock code there if you're interested in that one. I mean, looking at Woodside, I mean, it has been bouncing around a little bit, and previously this has been the top. Since February, we've seen the top around about that $36.50 mark. But it's amazing, you know, you think about dividend stocks on the market and you think the banks and Telstra, but more and more it is these mining resource companies. It's the BHP Billitons, the Woodside Petroleums with these strong dividends. For people seeking income, David, what would you say?
You need underlying growth, and it's fine to have a high-yielding stock, but if it doesn't have underlying earnings growth, then it's just a bond. And if interest rates back up, those stocks will be punished. So what I would say is you've got to look at the underlying business model, and you've got to be comfortable there is underlying earnings growth over the next 3 or 4 years. In the case of Woodside, and I agree with Richard, I think oil is apart from most other commodities. And
they can shut down those wells pretty quickly and then reopen them when things are going well, can't they?
And I think Woodside, it's moved to, it's another good trade. $34 to sort of, high $30 area. I think it's been a nice trade. But, would I buy it at the current levels? No, not for me.
Okay, so good as a trading position, a little bit harder to make an investment case over for the next 3 years, and probably see a little bit of volatility in both those stocks. But good on you, Russ, for having a good shot at those stocks and having a fantastic result there. Let's go to our next call. We've got Ken on the line from Brisbane. Ken, welcome to the show. What's your question tonight?
Yeah, thanks, Julia. Could David and Richard tell me what they think of the new float, Adairs and the Smart Group? Thanks.
Sure. So we might go to David to the Adairs IPO, because I think you might have had a look at this one.
Yeah, so we've done, a couple of my colleagues have done a fair bit of analysis on this, Julia, and we can't make it stack up price-wise, and I can't comment a lot about the quality of the business, but just we couldn't make it stack up, so we've let that one through the keeper. I should point out that we're actually sort of being offered quite a few IPOs at the present, so pre-marketing, etc., and my personal view is there's a certain amount of dross amongst those offerings. We're not seeing the high quality businesses we saw last year. So Isentia was a stock that came out June last year at $2 odd, and it's now sort of $3.60. We saw International Patent Holdings, that owns the Spruce and Ferguson patent business. It came on at $2. It's now $4.60. So we saw some really excellent high quality businesses last year, but more recently we're seeing a bit more rubbish.
Okay, and just before we go to break, just quickly, Smart Group, SIQ is the stock code. A lot of these companies that look at fleet leasing, anything to do with cars, doing very well, reaching 52-week highs, and Smart Group no different. Richard, what's your view on this one?
Far out. This thing's had a big run, and so is it salary packaging at all, or is it?
Salary packaging.
Is it salary package? Because I'm just not.
They look at fleet leasing as well, novated leasing.
Well,
services.
I just think those stocks, people are in love with them because of that annuity-style revenue model, as they were with Macmillan Shakespeare, despite its weird name, and they look at the many times that the government's tried to reform that system, and Kevin Rudd had a good go at it, but it got knocked back. So I think that there's general view that nothing's going to happen for at least the next 18 months on that side of things. But I think at the end of the day, we're just not that enamoured with rent-seeking type companies. So that's why we don't really have that much appetite. I had a big argument with Roger actually about Macmillan Shakespeare. I said, why would you ever buy a company where you could have the rug pulled out from under you? But there's a price for everything, and admittedly now I think these are good conditions for those companies.
Okay, so good conditions for these companies. David, would you agree? I mean, Macmillan Shakespeare, AP, Eagers, SIQ, Smart Group, the company that we're talking about, all at 52-week highs, if not all-time highs, right at this moment. So what are your thoughts?
Well, we bought Macmillan Shakespeare the few days after the crash, when K. Rudd sort of announced exactly what he announced, that really nearly crucified the industry, and the stock more or less halved from $16 to $8 a share or thereabouts, and I think it's taken time for the market to become comfortable, and every time there's a budget I think the market breathes a sigh of relief, and
that's need money after all,
and that's pretty much exactly what's played out. The earnings have always been pretty solid, apart from that December half year in question, around the election, coming around for 2 years ago now, I guess. But I think it's a confidence thing is returning to these oil stocks.
Okay, so confidence returning to these stocks, and of course with anything car related at the moment, that small business tax deduction, obviously good news for those stocks as well. Now, if you would like to ask our expert panel a question, please give us a call on 1300 30 34 35, or you can email us at yourmoney@skynews.com.au. We'll be back with more after this short break. Welcome back to the program. I'm Julia Lee from Bell Direct, and joining me on the panel tonight we have David Buckland from the Montgomery Fund and also Richard Hemming from Under the Radar. So if you have a question you'd like to answer, please give us a call on 1300 30 34 35, or you can email yourmoney@skynews.com.au. And it is now time for a viewer email. We've got one here from Michael. And Michael writes, I bought into Primer Biomed at 12.5 cents. The market cap indicates to me that intelligent individuals must privately think future results will be positive as they refine cancer result trials. Does the panel agree with my thoughts? Wow, this company's been around for a while and burnt a lot of cash, and it's nice to see the share price finally moving. The stock's up 280% just over the past week. PRR is a stock code. I think Lucy Turnbull's the chairperson of this company. They're also listed in the US. Richard, we might go to you. What are your thoughts on this? Ovarian cancer,
well, I think
immunotherapies
are like, you know, they're kind of the gold standard in terms of if you can get it working, you know, using your immune system to attack cancer, it's the ultimate, because you're obviously not injecting all that chemo into you, so you're not killing the body and trying to fix the cancer, you're using the body to fight the cancer. It's pretty amazing stuff, but it is very it's very speculative. Like, it's a one-trick pony, not to use that expression, but basically I think these sort of companies, even if they're in phase 3 and onwards, you're looking at very low probabilities that they get approved from the FDA, because the FDA has hardly approved any of these sort of treatments because they're, you know, scared of side effects, and you know, the regulatory regime has never been tougher. So I think it's very much a shot in the dark. And if you own something like PRR, Primer Biomed, I would encourage you to own like a suite of these sort of companies to hedge your bets, because we've seen like over and over again the kind of binary molecular roulette of these companies, and we've been on the favourable side of them with Certex in the past, but you have to realise when you've been on a winner as well. And those sort of companies in the medical, the ones that we favour on the medical devices side, they don't have nearly the same regulatory hurdles that a Primer Biomed has to pass to get approval from the FDA. I mean, it's just unbelievable that the science on, you know, that they're utilising. But having said that, from an investor standpoint, it's, you know, there's so much in the box that you can't see that even for us that are, you know, we look at this sort of sector closely, we think it's too risky.
Okay.
So you talked about, you know, the 280%, but that's like, you know, when I got back here from the UK, where I used to cover Biotech for the FT, like, the stock was like 20 or 30 cents. Now Lucy was ringing the bell, and the NSC, you know, the NSC saying, "Look at me," you know, and the stock was going to the moon. And then I said, "Wait a second, like, let's just calm down a second. You know, it's early stage." And then it came off, and then, you know, I got some emails, but I won't talk about that.
I mean,
there's a different sort of perspective that you have to take with these things as a business person, as an investor, to someone who's a cancer sufferer.
Absolutely. I mean, a month ago this stock was 2 cents, and now it's 13 cents.
But a year, 3 years ago, it was 30 cents.
All-time high was actually at 81.2 cents. So it's been a roller coaster ride. Richard, with some really good points there. He likes to concentrate on medical devices rather than
well, we think that there's less regulatory, less hurdles. We can see, often when you can see revenue streams, it gives you a lot of confidence. These are research and development stories like that are listed.
And it has been a long wait for Primer Biomed shareholders.
It has
been. I mean, it's phase 2 results of second remission ovarian cancer patients, which has shown 16 extra months that they live during this particular trial, but it's been 5 years worth of data collection. That's a long time for a company not to be bringing a lot of revenue through the door. David, what are your thoughts on Primer Biomed going forward? They've made it to phase 2.
Yes.
So early stage.
It's look, it's highly speculative. You can't say anything else. It doesn't have solid revenue. It doesn't have solid earnings. It probably has to go to its shareholders on a regular basis to raise more capital for the next 5 years. You know,
the Turnbulls have a lot of money.
Yeah, you know, we would rather invest in companies that have revenue, have cash flow, and have good prospects. You get to these businesses, you can talk to 50 doctors who are absolute specialists in this, and 35 of them say this is an absolute winner, and 15 of them say not sure. They have about as much idea as the next person. So it's speculation.
Okay, so really hard to evaluate. That was Prima Biomed, fantastic week, up 280%, but of course it's been a roller coaster ride throughout the last few years. Now
just one more point. I wouldn't get too excited about smart people being in a stock. These were the same smart people that were in chaos music that seemed to sort of, die by the wayside, etc., etc., etc. So don't get obsessed about smart people being here, there or anywhere. Do your own homework.
Smart people have lost fortunes.
Yeah, do your own homework and work out whether the business model is sustainable and growing.
Okay, so some good points there. That was Prima Biomed. Roller coaster ride, but luckily for shareholders, the roller coaster ride was up this week, up 280%. Let's go to our next caller. We've got Arthur on the line from Melbourne. Arthur, welcome to the show. What's your question tonight?
Hi, Julia. It's not really a question. It's more of a statement about MYOB. MYOB was offered as an IPO firstly to the users and then taken up, subscribed by the institutions. Now, what people don't realise is that the users who were actually given the stock were not able to trade a week until after it actually listed. And most people like myself as a trader, I knew the stock was overvalued and couldn't sell it for a week. I mean, I had 4 different brokers, and no one would let you sell it until the actual issue sponsored was issued. Well, the institutions could day one trade. As we know, the stock's gone down. I'm just pointing out how unfair this is. This type of thing, we say the market's an equal market, but it's far from equal. And, to me, it just shows how the institutions really control the market and that the general public has no say or there's no care by how they treat the individual investor. I just thought the panel should understand that type of thing.
Sure. So just, I guess, a statement by Arthur regarding initial trading in an IPO. My understanding was that it's deferred trading until a certain date, so even though your stock doesn't show up in your account, you can still sell it, but you have the responsibility.
There was a lot of confusion about that, wasn't it, with the Medicare, because people weren't issued HINs and stuff like that. There is, I don't think they have it sorted, really, the process, do they?
So I guess it's more of a statement coming through from Arthur. So about MYOB, does anyone want to make any?
Well, in MYOB, I think it's a case where those private equity guys, I think it was Bain Capital, made a lot of money. That thing, they bought that thing on 6 times EBIT and it's trading on like 12 or 13 times EBIT. They made a lot of money, and always as an investor you have to be very aware of the vendor. It's like when you buy a house, you look at the street and you know all the prices around and what they've done to the house, and then you make a decision based on that. Well, I don't think the same kind of disclosure is necessarily there in these bigger companies, and that started off with Myer. And I'm just very, very careful when it comes to IPOs, because I actually interviewed these guys from UBS who are fund managers, and you'd think they had an entree into the IPO world, and they've only invested in 3 IPOs of the last 40 that have come across their desks.
So this is a small cap funds team that you interviewed?
Yeah.
From UBS. So a good point there by Richard. Have a look at the vendors, private equity, making a lot of money in this MYOB IPO. And of course, MYOB used to be on the market and then it got bought by private equity. Now it's back on the market. Let's go to our next caller. We've got Sean on the line from the Gold Coast. Sean, welcome to the show. What's your question tonight?
Hi. I was wondering the panel's thoughts on Horizon AZJ and whether it's worth a buy, and that a technical analysis on that it's just broken through long-term resistance and into all-time highs.
Absolutely. It's always a good point from a technical point of view when the stock's reaching all-time record highs. Having said that, you wouldn't expect a stock like Horizon to be reaching all-time record highs. rail operator, you've got iron ore projects, that are doing it pretty tough. Coal projects doing it pretty tough as well. And despite that, we've seen Horizon lifting iron ore guidance from 23 million tonnes to 25 million tonnes. You've got the stock hitting all-time record highs. There's the enterprise agreements. There's been renewal in that area and a good ruling in Queensland. Would you be buying Horizon, David?
No, I wouldn't, Julia. Too expensive for us. Low return on equity business, capped at $11 billion, I think we talked about a bit earlier. And as I say, its multiples are just way too high for the sort of prospects that the business commands from our point of view. So yeah, we just can't make it stack up.
Okay, so too expensive for David. I mean, Richard, how about you? A lot of the brokers are quite positive on this one. RBC's got an outperform on it. Credit Suisse has got an outperform. Does Richard Hemming have
Well, I just think it's way too big. I mean, we look at companies 300 million and more, and I think the fact that all the brokers are really positive, I mean, I don't always look at that as a positive, because it means that that's very much in the market. I mean, they've pushed all their customers into it. This kind of company is a great company because it has a business that that's relatively bulletproof. But I would say that it's going to be trading like a bond, more or less. Like it got a spike because, as you said earlier, they had a good decision on IR, but I don't think there's going to be many occasions where they're going to get really good news like that very often. I mean, it's a pretty bulletproof stock. So I'd say, sure, it's a good company, but wait till it falls and you can see a yield that I guess is impressive. And I think the yield's something like 3% or something on that. I think it's just way too expensive for me to put in my portfolio.
Okay, so both our panelists thinking that Horizon looking expensive. The stock, it has broken through and it's reached all-time record highs. But Richard's saying that there aren't any catalysts like this IR industrial relations result that we've seen that will continually help to drive the shares higher. Now, we are going to take a short break, but we'll be back to answer more of your questions in just a moment. Welcome back to the Shares edition of Your Money, Your Call. If there is a question you'd like answered, please give us a call on 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And we now have David on the line from the South Coast. David, welcome to the show. What's your question tonight?
Thank you, Julia. My question is this. I've got a self-managed super fund in pension phase. I'm particularly interested in yield, but I wanted to get some diversity from the usual sort of yield stocks. And the two I was thinking about were in the health sector, primary health care, and in the fund management sector, Platinum Asset Management, and I wondered what views the panel might have on those.
Sure, this is probably a good question for you, David. Primary and Platinum Asset Management.
Primary basically is a relatively poor quality stock, given it's in the healthcare space, in that its return on equity is sort of 5 odd percentage points, and you see some of these better run healthcare businesses that are 20s and 30s and 40s and can keep reinvesting their capital at very, very high rates of return. On to Platinum. Look, it's a very good business. It's run by an excellent individual. I just make the point that from our point of view, if you're going to go into fund management, I would prefer Henderson's, which is also dual-listed UK Australian business, but it's going to benefit greatly from the declining Australian dollar versus both sterling, particularly sterling, and it's really enjoying the big pickup in the market over in Europe and the UK. So we prefer Henderson's, which is HGG, and the other one we quite like is the BT fund management group. BTT is its ASX code, and it's got enormous operations in the UK, and it's also moving into America. So value for money there too that we would prefer over the Platinum Asset Management Group.
What about some ideas in the healthcare space, which is a bit harder because it has run so hard?
Oh, look, it is difficult. I mean, there's a lot of superb businesses in the space, but it's very, very hard to find value for money because, as Richard said earlier, the market market has really separated the wheat from the chaff, and the good quality stuff has been chased very, very aggressively, and so it's hard to find excellent value in the space, yet that space will probably deliver, very reliable earnings growth, and a lot of it has offshore earnings. So if the Australian dollar, continues to decline somewhat over the next, year or two, a lot of those healthcare companies will benefit from that $8 depreciation.
Okay, so an Australian dollar play there with a lot of those healthcare stocks. Richard, in the healthcare and the financial services space? What do you think?
Well, we've been backers of Main Pharma for a while now, although that stock's, it's still sort of, we've been backers of it since it was 33 cents, and that company that company went from like a small cap based on, that we thought was undervalued based on its sort of individual drugs, to being kind of like a growth play in America, based on a good business that it seemed to get cheap. Now it's transforming into a big cap, I think, with getting distribution capacity over there, distribution potential or distribution over there in the States. And
MYX is a stock code there for Main Pharma. And what about in the financial space?
In the financial space, well, I'm looking at Silver Chef at the moment. I think there's definitely, we've made some money. People have made a lot of money out of the shadow banking, because that has been a big area where the banks have left fallow because their margins are so good post the financial crisis. That's our preferred stock in that space because it's got a good niche.
Okay, so Main Pharma and Silver Chef, the preferred stocks for Richard, and also some alternatives there in the financial space from David Buckland as well. It is now time for a viewer email, so let's go to this one from Christine. And Christine writes, what are your thoughts on Greece and how it will affect our market and why? Also, if you have time, I would appreciate the panel's comments on APA Group.
So Greece, just to give you...
Easy question.
Yeah.
Well, okay. How long have you got?
just for a quick an update, the Australian economy is about $1.7 trillion. The Greek economy is about $250 billion. So it's about a seventh or some sort of factor of that versus Australia. The problem is its indebtedness is off the Richter scale. And what we've seen, as I mentioned in my introduction, is we've seen all these bond markets, particularly in Europe, get down to record lows. And Germany got down to sort of 0.07%. Wow. We saw Italy roughly 1%, France roughly 1%, et cetera, et cetera, et cetera. And what's going to happen is, if this gets pretty ugly over the next few weeks, all those bonds will back up as fear rises, and it will put pressure on markets as volatility increases. So we don't know how it's going to play out. I don't think anyone does, but it is scary. And what we should also point out is there's a lot of countries in Eastern Europe. I reckon there's probably 8 to 10 countries in Eastern Europe that are in quite bad, not as bad, but quite similar situation in terms of their indebtedness is off the Richter scale versus their ability to pay back. So at some stage there could be a bit of a domino effect.
Okay, and your views on Greece?
Well, I think everyone in powerful positions like creditors, they always cite the domino effect whenever anything bad to strike fear into the hearts of those poor debtor nations. But the reality is, Greece should have been separated from the euro. They should have allowed the drachma to float. I mean, basically they're just a protectorate of Brussels. There's only austerity is not going to be a solution. So somehow the creditors have to take a haircut, because there's no way they're going to get their money back.
So impact on markets?
No.
No impact.
I don't believe in the domino effect, though. I think it's
so just a short term, maybe a little bit of volatility.
Yeah, I think there's definite, there's definite risk. It does have some concern, but I think a lot of people play up the concern because they are the owners of capital, and they have it in their minds to protect their other investments around there, because they don't want haircuts in these other countries that David's talking about.
Okay, so your view is that it's already a known risk, so it's
I think everyone knows that.
Mainly into the markets, whereas David's view is that we don't know how it's going to play out, and there could be a domino effect in that region.
Well, it could be volatility
in bond prices, which of course has a big impact on asset prices at the moment, because a lot of our stocks just trade in line with bond prices.
Well, we've never seen bonds so low in hundreds of years of governments issuing bonds.
Yeah, I mean, I think we're in the unknown territory, aren't we, really, with this quantitative easing? I don't think anyone really has a clue of what the end game with this is. They're just playing the momentum game. So David's right, but there will be volatility, but I don't necessarily think the Greece situation will bring that on.
Yeah, we can probably spend a whole show on this, but let's go back to the stock, which was APA Group. They have made another acquisition, long life, stable cash flow.
I think it's a great company. I think it's they own the pipelines, and they are like the infrastructure, the key to linking up Australia. It's just a fantastic company. It's just, for me, it's just all about yield. Because like a lot of these companies, they trade like bonds at the moment. I think it's a good stock in your portfolio, and you can afford to wait.
Okay, so a yes from Richard. We don't have a lot of time left. So David, APA Group, they just reached commercial completion of the QC LNG project. So once again, expanding their pipelines. What are your thoughts?
Just too expensive for us, Julia.
Wow. Okay, so too expensive. It does look like it is quite hard to find value on the market at the moment. A lot of those good quality companies have run, and it is an interesting time. On that note, that is all we have time for today. Thanks so much to our panellists for a fantastic show tonight. David Buckland from Montgomery Fund, and also Richard Hemming from Under the Radar. And to you, our viewers, for all your calls and your emails. Till next week, I'm Julia Lee from Bell Direct. Thanks for your company and have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.